The fastest way to stay broke in America is to buy a car that makes you feel rich for 10 minutes and then traps your paycheck for the next 6 years. That car loan is not just a payment, it is a speed limiter. It is the invisible wall on the highway. It is the final boss hiding inside the dealership office, wearing a polo shirt, smiling and asking, "So what monthly payment are you comfortable with?" And that question right there is the trap, because the second you start thinking in monthly payments instead of total cost, you are no longer driving the car is driving you. Picture your financial life like a Forza race. You start with a basic car, nothing crazy, maybe not the flashiest thing on the grid, but it moves. You have a little money coming in, a little gas in the tank, and you're trying to build momentum. Every dollar you save is traction. Every good decision is a clean turn. Every investment is a nitro boost that gets stronger over time. But then you pull into the dealership like it's a festival garage. You see the shiny paint, the leather seats, the giant screen, the aggressive front end. The car looks like success. It feels like a level up. Then the dealer says, "We can get you approved today." That sounds like winning. It's not. Getting approved does not mean you can afford it. It means the bank believes they can make money from you. That's different. Right now, young buyers with fresh credit history are getting absolutely slammed with average APRs climbing over 11 to 13% for used cars. A high-interest car loan like that is like entering a race with the parking brake halfway up. You might still move, you might even look good for a few seconds, but your engine is screaming, your speed is capped, and everyone building wealth around you is pulling away, while you're stuck paying for something that loses value every single mile. And the wild part is, most people don't even realize they're losing the race until years later. They just feel slower. They work hard but never build cash. They get raises but still feel broke. They want to invest, but there's nothing left. They want freedom, but every month starts with bills already waiting at the starting line.
That is the car loan trap, and today we're breaking it down like a racing RPG build. We're going to talk about how high-interest car loans destroy your financial speed, why dealerships make the numbers feel smaller than they really are, and how to buy a car like someone who actually wants to build wealth. Because the goal is not to never own a nice car. The goal is to not let a car own you. Let's start with the biggest lie in the dealership world. It's only this much per month. That sentence is financial smoke. If someone says a car is only $499 a month, your brain might go, "Okay, that sounds possible. Maybe tight, but possible." That's exactly why they frame it that way. Monthly payments make huge numbers feel tiny. It's like judging a race by one corner instead of the whole track. But the full race matters. With the average new car payment hovering at an all-time high of over $760 a month, a $30,000 car at a high APR over a long car loan term can easily turn into thousands and thousands of dollars in interest. You don't just pay for the car, you pay for the bank, you pay for the risk, you pay for the time. And the longer the loan, the more dangerous it gets. A 72-month or 84-month car loan might make the monthly payment look clean, but it stretches the pain across your life like a highway with no exit ramp. 6 years, 7 years, that's not a car loan anymore. That's a relationship, and not a healthy one. A car is a depreciating asset. That means it goes down in value over time. Every mile, every scratch, every model year that passes, the market value drops. So when you finance a car for too long, especially with a high interest rate, you can end up owing more than the car is worth. That's called being underwater. And financially, that is one of the worst feelings in the game. Imagine your car is worth $18,000, but your loan balance is $24,000. You want to sell it, you want out, but the exit costs $6,000 just to break even. That's not freedom. That's being locked behind a corporate paywall.
Now add insurance, because people love to calculate the payment and forget the full build cost. The payment is not the car cost. The real cost is payment plus insurance plus gas plus maintenance plus registration plus repairs plus tires plus the money you are not investing because the car ate your cash flow. That last part is the silent killer, opportunity cost. That's the money you could have used to build an emergency fund in a high-yield savings account earning around 4 to 5% passive returns. That's the money you could have put into broad market index funds to buy a piece of the American economy. Instead, it becomes interest. You're not just losing money today, you're losing the future version of that money. In racing terms, a bad car loan doesn't just slow you down on one straightaway, it messes up your entire lap time. The wrong question is, can I afford the payment? The better question is, can I afford this car without slowing down my entire financial build? Big difference. Because yeah, maybe you can handle the monthly drag, but can you still build your emergency fund? Can you still invest? If the answer is no, that car is not affordable. It's just approved, and approval is not the same as power. So how do you buy a car like a strategist? You follow the 24-10 rule. Put down at least 20% of the total price as a down payment, never finance a car for more than 4 years or 48 months, and ensure your total transportation costs, payment plus insurance, never consume more than 10% of your monthly income. If you can't fit the car into those parameters, your character isn't ready for that gear yet. Go find a reliable used starter vehicle, build your credit score reputation, and stack your cash. Stop running the race with the parking brake pulled. Lock in your build, protect your cash flow, and dominate the track. Hit that subscribe button to join the ultimate financial party, and let's level up your wallet together.